Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Jared Dillian, author of the Daily Dirtnap newsletter and also of the just published short story collection, Night Moves. Hi,
Yes,
Jared.
yes, yes. Thank you.
How are you doing?
Good to see you again.
Yeah, it's good to see you too. Listen, that is a big deal. Wait, hold on one second. I'm hearing myself back somewhere. I just got to fix that. Okay, there we go. Um, so wow, there are not many people that wear the financial hat and creative hat as well as you, Jared. How's it feel to have this? I know you were working on it. How's it feel to have this novel out in the universe?
Um, Really good. I wrote my first short story when I was 21 years old, and I thought it was amazing at the time. And now I go back and look at it, and it was terrible. But um, no, this is a great short story collection. It's a little bit on the dark side. Not a lot of happy endings. I'm really really pleased with the writing. The reviews I've gotten back so far are amazing. The only thing resembling even a neutral review was somebody said the characters were unsympathetic. But people really love the writing. They love the stories. Night Moves and other stories. It's out now. So
Awesome. Awesome. Well, congratulations. You should be really proud of yourself. And we'll I know you'll keep us all posted on where book signings are and all that kind of stuff so we can
yep.
come out and support you. So if we take a look at the market action, it was a kind of a funny day because stocks were lagging for a lot of the day. It looks like they maybe turned positive at the end, but no doubt about it, it's been a positive month, positive quarter for equities, which is saying something given September can be nasty sometimes. Oil, on the other hand, continues to be depressed. Bond yields have been creeping up and prices down, despite the fact that the Fed looks like it's going to ease. So, when you look across all of these different assets, what's top of mind for you? What are you most interested in right now?
Well, basically, what happened a month ago is that we had a big bottom in commodities, and commodities had pretty much rallied across the board except for oil. Oil is super interesting. Um, Everybody is short. Okay, everybody is short. I saw an article today from Goldman Sachs, their prime brokerage department said that their hedge fund clients are the most short energy stocks in like the last 10 years. This is one of these things like I wrote the Daily Dirtnap for about 18 months in New York before I moved to South Carolina. And when I moved to South Carolina, like I just got a lot better because I'm not in the middle of this groupthink bubble that everybody is in New York. Like everybody goes to idea dinners and drinks and stuff like that, and they share all these same ideas, and everybody's in the same trade, you know. So I'm here in South Carolina, and I'm like, guys, like this is this is massively crowded, and people are pressing and pressing and pressing on the short side, and it's like holding a beach ball underwater, like it's gonna bounce. So I am super bullish on energy for sure. Actually bought some calls on XLE for the personal account about a week or two ago. Some long dated calls. So
So, what do you
um,
think? It's interesting because I think people look at the situation, what's happening around the world, especially when you look at the tensions that are building geopolitically. And it feels like oil should be higher, but that's been the case for months now, and it doesn't seem to be breaking out. So what do you
yeah,
think's the catalyst, or how do you approach it when you think you're right, but the trade's not going your way?
like I never know what the catalyst is going to be. Like maybe it's something geopolitical, but the thing about geopolitical events in oil is that everybody has been trained that geopolitical events usually mark the top of a move rather than the bottom. So no matter what happens in Israel or Iran or the Middle East, like people have just been conditioned to sell the rally, right? So, over the weekend, they Israel killed the Hezbollah leader, whatever his name is, and oil was up like 20 or 30 basis points this morning. Then it was down. Then it was up. Not a lot of reaction out of that. So I tend to think it's not going to be a geopolitical catalyst. But if you look at short positioning in futures, it's actually there's people are more short oil now than they were in 2020 when prices went negative. Like that's how consensus this is. So it's really when positioning is this short, it's only a matter of time until you get a squeeze. when I look at technicals, I actually think it bottomed 2 weeks ago. We bounced a little bit. We came back down. I think the bottom is in, and I'm just hanging out waiting for a rally. So.
Sorry, I was on mute. So you're right about the geopolitics, that people have been conditioned not to trade. It hasn't responded. So if you're bullish about it, are you bullish the commodity, or do you like oil producers as well? How are you thinking about that?
Well, from my time at Lehman, I was an index trader. I'm a terrible stock picker, right? Like if you gave me 30 energy stocks and you asked me to pick the best performer, like I couldn't do it. Like I don't know how to do that. So I just buy the index. I just buy XLE, right? Or you could buy the commodity, either way. So
Uh, let's talk. Let's just sort of put this in context. I want to come back to oil and energy in a second, but what's happening with the economy? Do the economic fundamentals matter to you when it's energy? It sounds like you're saying, "Listen, I just think this is overcrowded to the other side, to the bearish side, and things can't continue." Or is there some fundamental story you're looking at too that makes you think that oil is poised for a rally?
well, this actually kind of feeds into my broader thesis about, I mean, if you're talking about the economy and oil, you're talking about the demand side of the equation. And I think the demand side of the equation is fine. I took a trip to Connecticut over the weekend, stayed in Mohegan Sun, visited my high school, stuff like that. And the airports, the Charlotte airport, I have never seen it more crowded. Never seen it more crowded. It was a madhouse. I go to the Amex lounge. There's like a half hour wait to get into the Amex lounge. It's a food fight. It's full.
I
Like,
think there's always a food fight at the lounges now. They're giving
yeah.
that they're giving access. You can buy that access now.
So, I mean, the Fed is operating under a certain set of assumptions, and they believe that because the labor market has weakened a little bit, it's a sign of broader economic weakness, right?
Mm.
And my thesis is that this labor market weakening that we're seeing is not a sign of economic weakness. And really, what it is it's a process of normalization from the pandemic 4 years ago. So, in the pandemic, we put $4 trillion into the economy. We created all these labor shortages. You went to a restaurant, you couldn't get served, they didn't have people. And we had these labor shortages for like 2 years. And you saw job openings at like 11 million, and that's come down to 7 million. And finally, after 4 years, we've worked off a lot of the distortions from the pandemic, and the unemployment rate is up 0.7%. And the Fed looks at this and says, oh my God, like we're going into a recession. And it's absolutely not true. Like everywhere I go, I see signs of strength in the economy. I think it's incredibly strong. I think that cutting rates, however much they're going to cut it, is a mistake. I think it's absolutely a mistake. Now, you could say that monetary policy was too tight. You can say that real rates were 2.5%, and they belong at 1%. And I guess that's an okay argument. But the economy is not weak. Let's put it that way.
That's very interesting given the fact that the market is sort of pricing in quite a bit of Fed rate cuts, and the Fed's saying they're going to cut again, maybe not as aggressively as the market thinks, but that they're going to cut again. You think they're too focused on the labor market?
They are too focused on the labor market. And interestingly, you did see 2 year yields pick up a little bit this week.
Mhm.
We were pricing in about 9 or 10 rate cuts. They were pricing in taking Fed funds down to about 3%. I don't think that's going to happen. I think, look, if we got back to neutral, where you had a real rate of 1%, you would be looking at Fed funds of 4%. So that's 150 basis points of cuts. I would bet against 10 rate cuts, but I am too chicken. I am, because really, like you can get your head blown off. Like we have payrolls on Friday. Like if we get a weak payroll number, like you can take it in the chin. So the market's pricing in 10 rate cuts. I think we get 6. I'm just too scared to bet on it. So
Yeah. Wow. So, and we have this weird thing happening now, that's at the intersection of what you were talking about, distortions and jobs. For those tracking the news here in the US, we're facing a strike, potentially a longshoreman strike that could cripple ports and good delivery and movement, all up and down the East Coast. Now, a lot of people are kind of thinking maybe it's so politically unpalatable that there'll be a lot of pressure and it may not happen. But what if we were to get some sort of disruption like that? This time it's not a pandemic, but it's a strike. What does that do to the inflation situation?
It's super inflationary, number one, and second of all, the interesting thing is that Boeing workers 2 or 3 weeks ago,
Mm.
they're in negotiation for a new contract, their union, and they were offered a 24% pay increase over 4 years, 6% a year, and they rejected it, right? So, what does that tell you about inflation expectations? If you're getting a 6% raise every year and you think you can't keep up with inflation, that means inflation expectations are very high. I don't know the details of what the longshoremen are asking for or what they're being offered, but my guess is it's something on the order of 6 to 10% a year. So inflation expectations are firmly grounded in the economy, which is exhibit A as to why the Fed should not be cutting rates. So
Yeah. Welcome to everyone in the chat, by the way. I'm looking at your comments, which is why I muted myself before so you wouldn't hear me banging away on the on the keyboard. But um Oliver just saying stock up on toilet paper. And no joke, someone sent me in my text chain um something about that as well, concerns about shortages again. We're all still, I think, traumatized from what happened during COVID. So, regardless of what happens, you could also see weird dynamics start to play out and disruptions that could affect prices just because of behavior. I mean, to your point, Jared, there's a psychological aspect to this when you're looking at wage inflation, whether you're looking in the short term with things like shortages or the long term for wages. The Fed surely must know that, and yet they're still saying they're going to ease. Are you surprised by that?
well, I mean, I'm surprised to the extent that they're doing that, but um, there's a lot of politics involved. And look, we got to go back to December 2023 when Christopher Waller gave that speech saying that the real rate is too high and monetary policy was too restrictive, and we started pricing in rate cuts around December of 2023, and we didn't get them until now. We got them in the last Fed meeting before the election.
Mm.
So, and that's another thing. Like we have an FOMC meeting the day after the election, right? So, what's that going to look like? And what does the election look like? And who wins? And what does it mean? And do we get protests or whatever?
A lot of
Like,
headline risk out there.
yeah.
So is the bond market sniffing out it's been interesting to watch what's been happening with yields because the rate cut came and of course stocks took off on it, but the bonds seem to be stubborn here. Yields have been creeping back up. Is the bond market worried about inflation? What do you think's happening with what we've seen in the price action there?
Well, it's been a pretty small. I mean, look, we've had a decent steepening. So I checked the curve last week and it was like positive 23 basis points. So we've had a decent steepening. Um, the back end of the yield curve acts poorly, right? The front end of the yield curve is still pretty bulletproof, but the back end acts poorly. And I think what you're starting to price in is two things. Number one, really, no matter who gets elected, you're going to get a lot of issuance, right? Especially if it's Kamala Harris. If it's Kamala Harris, she's not going to cut the size of government at all. You're going to get a ton of issuance, and that's going to weigh on bonds.
But do you really think Republicans are going to cut this? Has anyone cut the size of government? Really? I mean, I know they all talk about it,
I think
but
there's
it
at
seems
least a
like for the
chance.
last 50 years, all everyone's done is
I
spend and increase the size of government.
Yeah, there's at least with Republicans, there's a chance. I mean, you probably heard that Donald Trump was going to appoint Elon Musk to this committee to like eliminate government waste and stuff like that. Like, there's at least some sentiment towards that direction. Um,
Oh, that's
but
Elon calling now. You better take You
um,
call me next, and then we'll really have a conspiracy.
the other thing is inflation, right? So Andreas and a bunch of other people have this chart, this overlay chart of inflation in the 70s and inflation now, how you had these three waves of inflation, and we are at the trough in between the biggest wave. So if you believe in that kind of voodoo, then maybe we get a third wave of inflation. I actually think that's pretty likely because there, like I talked about with Boeing and the longshoremen, like inflation expectations are so firmly grounded. People cannot differentiate between the level of prices and the rate of inflation. So if you tell somebody that inflation is 2.6%, they think you're nuts. They're like, well, I go to the grocery store and it's $300. How can you tell me there's no inflation? I'm like, no, prices went up, but they're going up at a slower rate. That's all that means. But people, like 99% of people, cannot distinguish between the two, and they believe that they are going to get inflation. So what do? They go down to Costco and they buy like $800 worth of stuff and they put it in their house, and inflation just keeps rolling. So
Yeah, that's such a great point. Because and they cannot, not only can they not distinguish, they don't care. Right? They care, what they care about is what they're paying. So if it's rising more slowly or any of that math, to them it's just expensive, and they're going to ask for wages to try to compensate it and offset it. And they also kind of know once that happens, it doesn't go back down, right? Nobody's going to, my cable bill is not going down. Nothing goes down. It's very hard. I mean, food
yeah.
maybe, but it's kind of rare unless demand falls off and people are forced to
Basically,
buy it.
you would need a really bad recession, and that's what Volcker's rate hikes did in the early 80s. He raised rates to 14%, and that recession that resulted was one of the most severe recessions that we ever had. GDP was down 6% in a year. So you're talking about a massive deflationary force, and that's what you need to get rid of those inflation expectations.
And it's really hard to imagine that any Fed would be able to do that in this day and age, is to create a recession like that in order to kill inflation.
Especially right now before an election. So,
Especially not before an
yeah.
election, but I think hard to argue that it would happen even after they'd be fired. I mean, that seems like that would be the reality today. Uh, so the U.S. not headed toward a recession. You think the economy's strong, and there's a chance that inflation returns. What about China? We've had a lot. So o oil prices stubbornly low. US equities have been hot. Bonds are kind of looking toward this issuance, looking toward the inflation problem. But the big swing we've had as well, just this past week or so, has been China. I mean, Chinese equities up, I think I saw 26% over the last 6 sessions, because we've got stimulus coming from China. How does that plug into your equation? Are you watching that? How do you feel about the impact?
Yeah, I mean that's a massive inflationary force. And part of my thesis around commodities was that China would stimulate. They had no other choice. They had to. So, I mean, I think if you weren't involved in Chinese stocks the day before they decided to do the stimulus, then it's too late. Like 26% in a week, like it's too late. Like, sorry. Um, but really, that is, China is a powerful force for inflation or disinflation in the world. And what that means is that it's going to be harder for inflation to go down. So,
Mm. Which again, we have the Fed cutting rates into that scenario. Now, the last time they cut rates, they didn't know China was going to come out and stimulate. Do you think that's going to factor into their calculations now?
I think they are 90% focused on jobs and nothing else.
The
So,
Fed.
yeah.
So if you weren't in China, you missed it. Talk to me a little bit about trying to catch these trends, because it's tough, right? I mean, you would have had to have been buying China at a time when, or positioning in China at a time when people said, I mean, it was in the doldrums forever. They were still grappling with their bubble. Stimulus was slow to come, and a lot of people said it was uninvestable. How do you try to think about those trends? I know it's something that you think about a lot, and you're not afraid to be contrarian, but the timing is so tough.
Well, with China in particular, I'm not sad that I missed it because I am always bearish on China. I'm happy to be bearish on China. I'm not sad that I missed that at all. But in general, when people start calling something uninvestable, like that's the time to buy it. Like oil, for example, like energy, like that's to the point that we are in energy. Like people are calling it uninvestable, and that's the time to do it. So, you can, I mean, that's sentiment trading, right? Like that's pure sentiment trading. You can use charts to back it up. This is kind of how I make a living, like I buy stuff that nobody else wants to buy. I sell stuff that everybody wants to buy, so.
So what does that mean for equities and for tech stocks and some of the, we've seen some of the gains again at a time when it's pretty historical. A lot of people think we're going to ride this for the next few months. Do you go along for that ride, or do you try to position now because you're a bit worried about some of what you're seeing?
I think if you bought energy and shorted tech and put it away for a year, you'd probably be pretty happy. Yeah.
What kind of risk tolerance and you bring up time horizon, which is important, right? I mean, do you have to be a little bit more of a medium term investor to do that?
Well, time horizons are the most important thing, right? Because on a broader level, you have a thesis, right? Like my thesis is buy commodities. Like that's my thesis. So, and for the next 3 to 5 years, and that's great. But if you're managing money, there's a lot of ups and downs in between, and you have to smooth out the volatility. And I mean, this is what professional investing is all about. So it's good to have a thesis. The thesis is really a luxury for strategists like me. Like I have a thesis, I write it in my newsletter, and it's really up to everybody else's job to executing it, but executing it is very messy, right?
Mhm.
Because you can take big drawdowns. It's hard, and that's really where technicals come in and stuff like that, so you can manage it along the way.
So we've got some questions in the chat, and it's nice to see so many of you here. Uh, Question about copper before. Punkus said, I know JD thinks copper's a little pricey right now and he's looking for a pullback. What kind of price target would he be looking at to get back in?
I have totally screwed up copper. I've totally screwed it up. Actually, a couple of days before the stimulus, I thought it was kind of topping out, and then like 2 days later, it gapped up like 20 points. So I don't really have a good feel for copper right now.
Hmm.
Um, like I don't know, like buying it kind of scares me here. So
Well, it's tricky. By the way, I think some of you had a chance to listen to my conversation with Palo Macro. It's on the YouTube channel. You can find a bit of it on Substack as well. I'm there on Substack, by the way. Come join me there if you are a frequent Substack user. But he was talking about the prospect, Jared, of rolling bubbles in commodities because commodities are tricky, right? They can sort of have these huge spikes and then they can move against you very quickly, and he feels like that this is an environment where rather than just being a broad super cycle for commodities, you could see individual markets moving really quickly. So it makes sense if you what you're talking about, the situation scenario you're painting with copper, for that to be the case because these moves come and the market can move really quickly. What about emerging markets? Because we have a question. I'm sorry, I lost it in the chat. It's moving so fast. Mark is asking for a friend, of course, Mark, about your thoughts on emerging markets. I know you watched the situation in Argentina really closely for a while. How you feeling about emerging here?
Great. One of the holdings I have in my newsletter, it's this ETF called DVYE. It's a high dividend emerging market ETF. Um, I I've had it for like 2 years, and it gapped up like 6 or 7% on the China stimulus. Really, if you it's all part of the same thesis. If you think the dollar is going to get weaker, if you think commodities are going to rally, if you think China is going to stimulate, then emerging markets are sort of at the intersection of all these things, and that should do really well over the next year. So for sure.
Do you like all emerging markets or do you segment it? Because I kind of feel like it's just sort of the same with commodities, right? It's an awfully big basket. Do you feel that because of that scenario you just painted, broadly emerging is going to do well, or do you have to really kind of pick and choose?
Well, I would say last year, the year before that, you had to pick and choose. You could not generalize about emerging markets. But I think with the China stimulus, they have all become correlated. And I think
Mm.
it's literally as simple as buying an emerging market ETF, and I think it's fine. So
Yeah. Well, that'll make it easier for folks. When we're talking about energy, sort of my same question, because I know people are always, if they agree with you, they're thinking, well, okay, how do I execute it? What does it mean for me? And of course, this is not financial advice, people. This is just Jared sharing his research thoughts. So you've really got to, you know, check your risk profile and time horizon needs. But with energy, when we were having that conversation before, are you mostly focused on crude because of the positioning in the market, or are you looking more broadly at energy, like nat gas, for instance?
I don't know anything about nat gas, but I've looked at the heating oil chart. I've looked at the gasoline chart. It all looks really compelling. It does.
Because everyone's
So
so bearish.
yeah.
Uh, It's always good, and I know you probably all do this, to think about the flip side, like, what if I'm wrong, right? So what would be something to cause you to rethink this larger macro thesis you have that the US economy is chugging along, inflation's gonna return, the dollar's gonna take a hit, emerging looks better positioned, everyone's too bearish, oil. What would change your mind?
Really, what could happen almost can't happen because what it would take would be a complete reversal out of the Fed
Mhm.
and a tightening of monetary policy, or maybe not even a tightening, but maybe we got some comments out of Powell today, which we haven't talked about, which were a little bit hawkish. But if the Fed, let's say, cut 25 in November and cut 25 in December, and then said they were done and sort of, manage people's expectations along the way, and they only did 100 basis points of rate cuts, then yes, this thesis would probably be busted for sure. But I don't
Mhm.
think that's going to happen. So,
What about productivity? Right? When we're looking at labor, like I know there are it feels like the labor market's tight and that's why people are able to go for these raises. If companies want to push back, because they're going to be looking at their bottom line, can they turn to technology, AI, robotics, all of that? Is there a productivity miracle that may be off the radar for people?
well, I think that miracle exists. I think that companies generally can make do with fewer employees. And the reason that's not happening is because they don't have to, they haven't been forced to.
Mm,
But if we were to have a recession and job losses, so let's say the unemployment rate goes to 6%, you would see productivity increase a lot. Like, for example, Google does not need 184,000 employees. They probably need 20,000, right? They can probably get rid of 164,000 employees. And that's the best example, but there's, especially in the tech world, like the tech industry has overhired to an extent that we haven't seen. Even a company like DocuSign has 3,000 employees. Like, why does DocuSign need 3,000 employees? So there's a lot of people in the tech world, specifically tech, that just aren't doing any work, you know? And that's this will all come out in a recession for sure.
apologies if you're working in tech and that comment freaks you out because that's pretty scary. If we did see layoffs to that extent, that would be pretty terrifying and pretty bad for the economy, wouldn't it?
Well,
Not really. I don't know. Would it?
short term it would be bad, long term it would be good. Long term it would be good.
Why
So
long term it would be good? Because it
well, because people would find employment someplace else, so their skills would be better put to use. The companies that fired them would have greater productivity, they'd have higher profit margins, like everybody wins. So,
yeah, it's interesting when you say that the financial economy wins, right? There is a difference between the financial economy and the real economy. And we've seen the Fed rate hikes have really helped the financial economy, at least equities. But is it that correlated to the real economy? I mean, it sounds like you're saying the real economy is just fine.
the real economy is just fine. It really is. Yeah,
What
it
about
is.
housing? I know you look at that. I did see more there was a big to do because mortgage rates have gone down a little bit. But I
I
don't know,
think,
is that
well,
gonna
mortgage
help?
rates, if you believe me on bonds, mortgage rates have bottomed, right? So we had a surge in refis, we had a surge in purchases, but mortgage rates have bottomed. Housing prices are bulletproof for a whole bunch of secular reasons, and the biggest one is immigration. We just let 10 million people into the country. They need a place to live. There's going to be this trickle up effect in housing prices. We still have massive housing shortages. Kamala Harris says she wants to build 3 million houses. I don't think I'd take the under on that. I don't think that's going to happen. Right now, we build 1.4 million houses a year, and if we did that for the next 10 years, it is not enough. If we
Mm.
did double that, it's not enough. We are chronically undersupplied.
Well, I guess if you get laid off in tech, you should go, look to work in the housing sector.
Yes.
That's our job advice today. Um, Jared, that was kind of rapid fire making our way around the assets, but I think it was really important given what we're seeing because we're starting a new month, we're starting a new quarter, and it feels like it's going to be a wild ride into the end of the year. Are you steering clear of the election altogether? You worry around about headline risk around that?
Well, I'm going to be trading the election. I'll be up that night trading for sure. And there's going to be a lot of heroes and a lot of body bags, but stuff is going to be moving on election night. So
All right, set your timer for that. Jared, so great to catch up with you. So great to see you on the show. Congratulations again on the book. We're super excited about it. Everyone can go find it on Amazon. That's right. Hold up that title, Night Moves and Other Stories. But honestly, if you get a chance, connect with Jared if you are at all inclined about creative writing because he is prolific. It is a huge, important part of his life. And we were joking before we came on air. I don't know when he sleeps with all of the hats he wears. But he really is dedicated to the craft, and it's amazing to see. So congrats, Jared.
thank you.
Thanks to all of you. We will see you again on Wednesday. Going to catch up with Tony Greer. Hope to see you there. In the meantime, as always, everybody take care and good luck out there.